most insurance companies sell bonds. What a bond does is it guarantees the performance of one person to another party. And in the area that we typically see the greatest need for bonds is in the construction or contract bonds. And if a contractor was hired to build a building and they ran into financial problems during the course of construction and were unable to finish the building, then the bonding company would pay the damages or hire a new contractor to complete the job. The bonding underwriting is pretty much similar to a bank loan process almost. For a contract bond, you need to provide your financial information, and what the company is looking for is to see if a company is strong enough financially to complete a job. Do they have the employees? Do they have the necessary equipment they need? Do they have the cash flow to complete the job? And if they are not comfortable that those pieces are in place and that the company has the ability to finish the job, then they may not provide the bond. If a company has a difficulty in obtaining a bond, you can obtain, we can use a collateral bond, which means you would have to put up a portion of the bond limit that the bonding company would hold on to until the job was completed. Typically, the collateral that a bonding company may require, they're looking for liquid assets. So it would be typically cash that they would want, as opposed to the collateral of equipment. On a collateralized bond, you would remit the amount to the bond company that they would hold on to, either a letter of credit or actual cash that you would provide the bond company. They would hold on to that until the job was completed. Once the job was completed, they would release it back to you. Typically, it can be both. If you have a contractor, for example, that does a lot of bonding, a lot of bonded jobs, then the company can put together a bonding program for them, which would provide them with a limit for each job and a aggregate limit for all their jobs that they have going on at any one time. Then you will also can find the contractor that may only need a bond once a year, and that would be done on an individual, is typically done on an individual basis. The theory behind bonding is that the bonding company really does not anticipate to ever have any claims, and that is why the underwriting is so strict and sometimes tedious to get a bond, because they want to make sure that the company that they are providing the bond for has that ability to complete the job, because it's usually very, very expensive to come in and complete a job once a contractor has failed. Contracting bonds are the largest portion of most bonding companies. They also do corporate bonds, which provides for employee dishonesty coverages, janitorial bonds, auctioneer bonds, licensing bonds, and it's where there is a requirement. What you're really covering is dishonesty acts, that if an employee were to leave and steal company's money, then the bonding company would reimburse them. Well, the bonding is a unique part of the insurance industry, and it's covering in the construction bonds, for example. There is no other coverage available under any of your liability policies or your package policies for the completion of a job. The bonds are typically required as part of a contract. And it's the promise to complete a portion of the contract, and the contract usually dictates the bond amount that they're looking for.